Welcome to Understanding Corporate Financial Reports. My name is Cindy Kilmark. Company financial statements provide information that investors, creditors, and analysts use to evaluate the financial health and stability of a company. They are useful for senior management in a strategic sense because annual reports illustrate a company's success and helps to clearly define future expectations. It's important to mid-level professionals because it helps up-and-coming managers to see if the trajectory of the company is in line with their own professional goals. And it is especially important for entry-level professionals who are the furthest away from the strategic goals of the company. They can use the annual report to instill confidence in the company and the work that they do. What are annual reports? Annual reports are comprehensive reports that provide information about the financial health of a publicly traded company. Typically, they contain general corporate information and are broken down into sections. There are financial and operational highlights. The Chief Executive Officer writes a letter to company shareholders. Financial statements, including a balance sheet, income sheet, and cash flow statement, are also always included, as well as an auditor's report. What are they used for, and why do companies provide them? All companies listed on the public stock exchanges are required to file annual and quarterly reports to the SEC. Annual reports allow creditors, investors, stockholders, employees, and even customers to analyze a company not only from year to year or quarter to quarter, which is called a horizontal analysis, but it also gives the information necessary to compare performance between more than one company, known as a vertical analysis. Through ratio analysis, another tool for creditors and investors, annual reports allow outsiders to accurately measure a company against its industry competitors and forecast trends within the company. MD&A, Management's Discussion and Analysis of Financial Condition and Results of Operations, MD&A, is a section of the annual report required by the SEC. This section is usually written by a company's upper management and isn't subject to audit. Often the MD&A contains information that isn't conveyed in the finance numbers. It typically provides a brief overview of the business, the trends in the industry, the company's strategy for growth, and a quick overview of the company's brands. This is where you will usually read about the company's biggest competitors and what they foresee as possible risks in the future. The four basic financial statements. A balance sheet is a financial statement that reports a company's assets, liabilities, and shareholders' equity. The income statement is an important financial statement used for reporting a firm's financial performance over a specific accounting period. Also known as the profit and loss statement or the statement of revenue and expense, it focuses primarily on revenues and expenses. Equity statement or statement of owner's equity illustrates the change in the capital balance of a business over a specific accounting period. A cash flow statement, a financial statement that shows how the changes in the balance sheet affects cash and assets, as well as breaks down the analysis into categories like operating, investing, and financing activities. The auditor's report, a written letter attached to the company's annual report that gives the auditor's opinion as to whether the company is following the SEC standard of generally accepted accounting procedures. The auditor's report usually consists of 3 paragraphs. The first paragraph describes the director and auditor's responsibilities. The second paragraph reiterates that the GAAP standards were the guide for the report. And finally, the third paragraph is where the auditor is entitled to share his or her objective opinion of the financial information in the annual report. Most audits end with the unqualified or clean opinions. showing that the auditors feel as though the company reports are accurate. The other three options are qualified opinion, adverse opinion, or disclaimer of opinion. A qualified opinion suggests the company's records weren't recorded in accordance with GAAP, but no misrepresentations were identified. An adverse opinion means that the auditor believes that the company's financial statements not only do not conform to GAAP, but are misrepresented or inaccurate. This is often an indication of fraud and is generally not accepted by investors or lenders. A disclaimer of opinion means the auditor cannot complete an accurate report, so the firm's financial status couldn't be determined. Fraudulent financial reporting, usually carried out with the intent of misleading investors and protecting the share price of a company. This ethics violation, done usually by management, involves tampering with the numbers in the financial statements. In the long run, there are always ill effects. Short-term effects on the company's finances is sometimes referred to as myopic management. Misappropriation of funds, otherwise known as stealing or embezzlement. Anytime someone uses company assets for anything other than company interests, they are misappropriating funds. This happens usually by an individual employee, but it ranges all the way from the cashier handling a customer's money to the CEO skimming money off the top to pay for a vacation home. Disclosure violations, failing to disclose information to investors or analysts that may sway their decision to invest in your company. And finally, penalties for violations. Thanks to the Sarbanes-Oxley Act of 2002, there are harsh penalties in place and legal protection for whistleblowers. This law also allows chief executives to be held criminally liable for misreporting financial information about their companies.